Welcome to the Lazy CEO Podcast, where Jim Schleckser, author of Great CEOs Are Lazy and founder of the CEO Project, features compelling experts and topics for CEOs of mid to large-size companies. Now, let's get started with the show.
Welcome, everybody, to another Lazy CEO podcast. My name is Jim Schleckser. I am your host, and I am the founder of the CEO Project. Well, when we talk to entrepreneurs, particularly founder entrepreneurs, or maybe even second or third generation entrepreneurs, one of the things that is in their mind is a liquidity event. In other words, how do we cash in on all this hard work and all this value we've created? Some interesting company of some scale. And, either I want to de-risk my portfolio. I'd like to maybe not have 95% of my wealth in one asset, or, it's just time to do something different. Any of those are okay. Well, there are a lot of vehicles for accomplishing that. But today, we're going to focus on one particular vehicle, which many of you probably do not think is available to you, which is an IPO. So, actually, there's a couple ways to go public. I shouldn't just say IPO, but go public, right? And we have an expert in the topic. We have Peter Goldstein. He's with Exchange Listing and MS Capital, and they help entrepreneurs of small and medium-sized companies look at this process and potentially execute on it. So, Peter, welcome so much. Thank you for joining us.
Jim, great to be here. Thanks for having me.
I appreciate it. So maybe we could just start with, what gives you credibility to be a guy somebody would want to talk to about this? Why talk to you, right? I mean, what's your background that causes you to be expert in it?
There are a number of touch points, Jim. First and foremost, I'm an entrepreneur for 35 years, and I've taken in varied roles during my capacity as an entrepreneur, founder, investor, and one of those companies that I founded and I started and I built was an investment bank, purposely to serve middle market companies in financing, M&A, and going public. And in addition to that, I've taken two of my own companies public, and I've been board member, advisor to dozens of companies, and my team, which goes way beyond me, has done this for hundreds of companies.
Yep.
In this micro and small cap space over my career now as an entrepreneur spans over 35 years, but 25 years specifically in the capital markets in working with, the exchanges being NASDAQ and the New York Stock Exchange, varied investment bankers and varied investment companies and the individuals that run those companies. So I am a participant inside of I would say a specialized ecosystem that's focused on, this micro and small cap community.
Got it. Okay. Interesting. So let me start with a really basic question, but if one was to go public, where would they be traded? I mean, if they're a small cap stock, I mean, I'm having visions of the Wolf of Wall Street and Pink Sheets, right? So help me understand,
right.
When we get traded, what does that look like?
Yeah, those days have changed.
Yeah, I figured.
Right. And what once was, the over-the-counter market and kind of that wild, wild west has graduated. And both the New York Stock Exchange, American, and NASDAQ capital markets have a place for companies to list with smaller market caps. And I think this is one of the myths that I want to share with your listeners so that they realize you don't have to be a unicorn to list on NASDAQ and the New York Stock Exchange. So from an entry point of a market cap or a company valuation, kind of the minimum that we see would be a $50 million valuation. Micro cap goes up to 300 million, and then small cap 300 million to $1 billion. So that's a wide berth. But listing on two of the most widely recognized exchanges in the world is possible without being a unicorn and being a micro and small cap listed company.
Interesting. So I said I was going to talk to you about this, but particularly with they're a little bit sitting on their hands at the moment, but private equity has been aggressive, particularly in the low interest environment, maybe less so now, to get deals done. And they've got just, metric truckloads of money that they want to put to work. So they'll frankly pay a little more than they probably should so they can put their money to work. It has become competitive from a valuation point of view with public, at least not in all cases, but many cases. So why public versus let's just go to the private equity, guys and gals and have them do the deal? Why would I go public?
I think it's an option, as you said earlier in your opening. It's one of the
Yep.
ways to look at a liquidity plan and look at developing, an exit strategy over time. You had your traditional PE, and now is an interesting time in history, Jim, because there's more money on the sidelines,
I know.
trillions, right, that hasn't been deployed in both PE and VC and in the capital markets. So what's unique, in 2021, we had one of the more robust IPO markets with a significant amount of capital and liquidity, where PE and VC were lagging. Now there is this kind of equality between all three of the difficulty for entrepreneurs to access capital.
Right.
Ultimately, it is an option, and there are pros and cons to every one of these different options. I look at it because it's my domain and it's where I put my energies and my belief that it gives you access to a broader bench of capital, and it gives you liquidity, and it gives you another currency to be able to utilize to attract employees, key members of your team, right? Advisors, directors, strategic partners, and the credibility that comes along with the rigor of being listed. And so by meaning that, especially the scrutiny that you're under and making sure that you have a compliant, well-governed, well-managed company that would be able to satisfy the listing requirements and the reporting requirements ongoingly.
All right. And I guess that's the big thing, which is if I need incremental liquidity to do a deal, to do an acquisition, to whatever, it's probably easier and more available in a public market than it would be in a private market. Because I'm going to take dilution either way, but why is it more available public? Maybe that's a better question.
Yeah, I think because investors have the liquidity built in to the investment portal that they're using. So if you're investing in a private company, liquidity is difficult, just by nature.
That can be, but there's some funds that say, hey, look, we're going to hold some dry powder looking for your next deal too.
Agreed. Again, it's not either or. I think it's just the optionality. And then, of course, institutions that have a mandate that require liquidity. So both and the reporting and the governance.
Right.
So it just opens up a wider playing field. And what's interesting, Jim, is that in the last 5+ years, you have a change in the demographics of the investment community on the public company side. And specifically, what I mean by that is retail investors now more than ever are participating in investing in these companies, both pre-IPO, IPO, and in the open market.
Mm-hmm.
Much now as 25% of the daily trading is through a retail-oriented trading platform.
Wow.
That didn't exist before. So it opens up another scenario where you're not just basing your investment on individual institutional investors, but a much broader base and a diverse range of capital and investment community.
Got it. Well, let's start through the go public process with pre. What if I'm contemplating this, and this is sort of tracking your book, which we'll talk about in a minute. What do I need to do as a leader if I'm thinking this might be an option for me to go public? What do I need to start doing kind of now, thinking out a year or two that I might go public?
Yeah, so we work backwards.
Yep.
Let's say I like to let companies use 2 years as a guideline.
2 years? Wow.
2
Okay.
years. It's as much as 12 to 18 months is probably more of the sweet spot.
Yep.
On average, for our clients, we find it's between that 12 and 18-month period.
Right.
And then working backwards, we start with the longest lead item, which is a financial audit.
Right.
And having a team built around the CEO to guide and create a roadmap through the process.
By the way, I'd precursor to that to have a well-regulated financial and well-controlled financial system, which many entrepreneurs don't spend a lot of time on, right? Certainly not at the level they need to be public, right? So
Agreed.
put that in place before we do the audit. That may take a year to get structured and appropriate, and then we do, so this may take even longer depending on where you sit going into the process.
Correct. And that's where we start with that first item of, looking at the longest lead time item. And then again,
Gotcha.
we work backwards. And our perspective on it for a CEO is that this is a very dynamic process. So it starts with getting educated about the roadmap and what would be required of your organization to shift from a private founder-led organization to one of going through the process. And there are many components to that, of course, that we sort of with financial reporting, because I think that's the biggest change organizationally that has to happen with, as you're saying, the systems and controls, and the knowing that you're going to be reporting in a transparent basis and shifting to a GAAP format of accounting, and then the requirements and the systems to go along with that. But that's only one of the many, this is a complex and somewhat chaotic process. So having that roadmap, just like any other journey, is critical to understanding the stops along the way. And that one is where we do like to start. And then we work towards, several other aspects, which we can, dig into in depth here.
Got it. So I heard financial reporting system or controls and accounting. I heard management team as well as a key item. What else is on that checklist of things I need to think about as I head towards this process?
Yeah, it's also really looking earnestly and honestly at your business and the growth and the scale of your business, knowing that there'll be a potential infusion of capital. So we look at the financial modeling and forecasting and knowing that there's real traction and demand for your business, product, service, technology, or other, that can, with the infusion of capital, demonstrate the growth and the key metrics to provide a compelling investor story. So that requires also very kind of deep look into all the different components of your business, from the business model through the competitive landscape and into your ability to perform to attract the institutional investors ongoingly. So I break the journey up as far as there is a number of things that we do to be able to get listed, preparation, and then to be able to thrive and sustain as a publicly listed company. And that's where a lot of entrepreneurs don't realize that as a smaller company, that you can access the capital as long as you can continue to perform fundamental growth that will satisfy, the institutional kind of metrics, right? So that business model becomes a real in-depth kind of deep dive that has to be taken as a portion of, am I a good candidate to be able to list my company by meeting the key metrics?
Yep. Yeah. Well, you don't want to show up at the dance and not know how to dance, right? So that's, so I hear you. And I've seen companies that go public and that, there was too much air in the ball, right? And they end up not performing to requirement, and their stock prices just get crushed and lawsuits ensue. And it's a very, very ugly profile. You want to avoid it if you can, certainly.
Agreed. And one of the ways to avoid that is to surround yourself with a team of professionals that have an understanding of what it takes to prepare properly, to educate management, educate your board, educate your stakeholders, as well as to execute and perform. So that's why we like this longer time frame, so that we can really be well prepared, which is the first half of the journey. And then the second, of course, is the execution until you get to listing day. And then upon listing day, it's really like running a race, right? You have to do whatever you need to do to be prepared to be able to run the race. And then when the whistle blows, you're now in a different phase of being able to be a public company and perform, on the playing field in real time.
Got it. So lead us up to go public. I said, all right, I've got my team. I've got well-controlled financials. Do I need a board, by the way? Do I need to put that kind of governance in place as well? Is that required?
It's required at the point of being public, right?
Right.
So, you need independence. You need, a minimum of a 5-person board with 3 of those board members being independent. And those board members are participating in different committees, audit, governance and compensation to
Yep.
put the systems and controls in place that are required. If you're going to NASDAQ, there's a diversity component on that board where you want to have at least one of those board members coming from a diverse background. That's a critical piece of the governance component. It doesn't need to all be in place day one when we start the journey. It just needs to be something that we're aware of. And part of our role, of course, and I sit on several boards, is identifying the needs that are the right cultural fit, the right professional fit, the right skill sets to complement management and to support management's growth and development.
I was on a board of a fairly large company. We were debating to go public or be sold to a strategic. And the board was in place and went from advisory to fiduciary. So it became a fiduciary board. And we behaved as though we were a public board before we were going to go public. And I think that's actually good practice because, the training wheels were off. At the point we were contemplating transaction, had we gone public, we've been like, well, it's the same as it's been for the last 2 years. It's no big deal. Nothing really changed for us. And I think that's better than, okay, now we're public. Oh, dang, we got to have committees and we got to have minutes and we've got to, have a secretary. It all changes and gets much more serious. It's better to work that out ahead of time, in my estimation.
I'm in complete agreement. Again, that's why we like this longer time. And what I would share with, with your listeners is, even if you don't pull the trigger, to your point of executing the IPO, acting as a public company brings great value to any organization. And that exercise of being able to work within a fiduciary, to work on your reporting, to understand the delivery and the requirements of what it would be like to be public, practice, right? Is just, but it's a different mindset, knowing that you're held accountable and you're transparent in the way that you operate and run and perform your business.
Got it. So lead us up to the go public. Lots of due diligence, lots of documentation. The S1 gets built, I suppose, which is the public offering document, right? Then it gets priced, and then we go sell the wheels off it, hopefully. Is that run? I know that's a hugely simplified, but run me through sort of, we're now in the tunnel to get this done. What does it look like?
Right. So for us, you touched on several, the key components, right? Your audit, which goes inside of the S1, which is a legal drafted. So you need good securities counsel who understands, the complexities of working with the Securities and Exchange Commission. The other critical part is identifying an investment banker.
Right.
So the investment banker is really the conduit between the company and the investors. And their role is to also to participate in preparing the company for the ability to raise that capital. And in micro to small cap, that's transformational capital. One of the biggest and most compelling reasons to do this is to have access to transformational capital and a tranche of. So that investment banker selection is critical. We work within the companies that we represent, but if for any issue where it's about identifying the proper bank that really has the right cultural fit, that understands your business, that has proven track record in the size in which you are. So if you're doing a $25 million IPO, it's very different than doing a $250 million IPO. So we work within that range from, tier 1 down to tier 3. And then critical is the banker as well as the bank. So you want a banker that's going to be the champion of your business, because that banker will be really representing you in the initial discussions to engage with, the investment community. So we look at that as a critical piece. And then, yes, Jim, once they're on board and you're going through that entire dynamic of the investment banker's participation, legal, audit, company, and then the exchange, right? So you have the option to choose, and we recommend you look at both. I work daily with both the New York Stock Exchange and NASDAQ. There's pros and cons, but we like to look at them as separate opportunities for companies to list. Mm-hmm. So all of those are part of the dynamics and the complexity around, then getting to the point where once all of those selections are made, you begin on the execution headed towards that roadshow, which is ultimately where you're interfacing with the investors and getting their understanding of how much capital they would want to commit and at what type of a price range.
Now, does the banker do that, or does the banker and the management team do that?
Yeah, I love this question, because one of the many misbeliefs is that, you know, the company can create a valuation. And many entrepreneurs love to look at lofty valuations.
Everybody has a dream sheet, man. Come on.
Right. And I've been there and I endorse it. Reality comes that neither the company nor the banker sets the valuation.
No, I mean talking to the investors.
Yes. And the
Okay, keep going.
investors, yeah, it's interesting because the investors really are going to look at their risk perspective of this company and look at comps and integrate the current market. Like in today's market, you're in one of the worst IPO markets in decades.
Yeah.
Valuations are compressed coming off of these lofty valuations. So everyone's driving for, you know, better value and better investment and looking at their risk profile. So the investors are really giving a range for which they're comfortable putting capital in. And then it's the job of the banker, of course, to get the best possible valuation. And the company is always in control. In other words, the company can say, I choose not to accept your valuation. This has happened many, many times.
Right.
Or I can choose to. There's typically not a whole lot of negotiation once you've gotten an investor pool that says, hey, here's a range.
Right.
And what's happening in this environment is they're all on the lower range of the range, right?
Yeah.
It's just the reality of today's kind of, you know, complexity around geopolitical, you know, economic factors. You know, we know all the things that are putting pressure on, you know, the financial markets in the current status.
Got it. So, boy, this feels like a lot of people around the table. What's it cost to go public? Let's say I'm $100 million, you know, valuation, all in enterprise value. What do I think? What is my financial exposure to go do this?
It's about $1 million proposition to go through. We have ways to compress that greatly, but that's also depending on, as you said earlier, what is the status of the company? How well are their financials organized? You know, what's their current, you know, organizational structure? Do they have a C-suite who's been through this process before? So there are some components. I would say that's the top end of the range. I've done it as much for my own companies as, you know, a fraction of that, $200,000-$300,000.
Right.
But that comes with a really deep set of practices, you know, preparation and experience leading in. So low end there, sweet spot, you know, $500,000. I'm a big advocate of taking longer and obviously budgeting more, and then coming in, you know, under budget and you know, under the timeframes.
Interesting. I mean, that's not massively different from a private sale in that size range. I mean, that's what I was found surprising. I was expecting him to give me a $3 million number and not a, you know, million sub number. So that's a little surprising.
Yeah, it's one of those myths, Jim, right? It's like the same thing that, well, you have to be a unicorn and, oh, well, it's going to take millions of dollars.
Right.
It's just not so. Now, you have to be very astute and have people that understand what current market practices are, what current pricing is for hiring, you know, auditors, accountants, you know, attorneys, bankers. So there's, you know, the understanding of market intelligence and how to keep those prices, you know, within that kind of manageable range.
Interesting. So one of the things we always hear about as entrepreneurs is lockups, right? So we want to go public, we want to get liquid, we want to personally get liquid, but I believe there are limitations in going public of how much of my position I can exit. So talk to us about that. Let's say I'm an entrepreneur and I own, you know, 90% of the business. I want to go public. How much of my position can I unwind? How much do I need to keep? What does that look like?
Yeah, so almost all of the insiders, which would include, you know, founders and management,
exec team. Yeah.
They're all locked up for, you know, a minimum of 1 year.
Wow. Okay.
Right.
This is like a slow motion exit.
It is. It is. And then inside of that, you know, as you would want to liquidate, you know, you're required to put together very, clear, transparent selling. So you're not selling into the market and with insider information. Those are done with the SEC calls a 10b5 selling plan.
Yeah.
And then you can liquidate on an orderly basis, but it is a slower roll. So if you're looking for an exit where you want to basically have a full out, this is not the path for you. This is to build more value over time with the ability over time to have liquidity and have exit strategy that's embedded in a longer term process.
Yep. Interesting. I was officer in a publicly traded company for a while, and between the quarterly reporting that we were blacked out in those windows, and every time there was a material transaction that I was aware of, I was blacked out. I mean, I had like 27 days a year I could trade the stock, right? It was a little rough actually. And it happened to be foreign. So we didn't have this option of what's the structured selling 10 something B?
10b5 plans.
10b5. Yes. It was not available to us. So that's the way to do it. Just sort of regular cadence of selling without regard to what's going on. That's transparent and fair as well.
Correct. You still have some golden handcuffs, right? But there is, the ability to get the benefit of some of that without being in that restrictive period on an ongoing basis. And that's one of I would say the tips and techniques that can be utilized, going forward post IPO.
The other thing that you have to be aware of, particularly as a CEO or even a senior leader in the team, is your sale of equity will be interpreted by the market. And so, even if you're buying a vacation house and you need $1 million to buy a vacation house, you sell equity to do that. The market is going to say, well, why the heck is the CFO selling $1 million worth of stock? That can't be good, right? So you have to be aware that you're in a very different environment than you might have been previously at that point, I think.
Everything is transparent. It's, the fishbowl analogy. With that said, what I've seen many, do is that they utilize that stock as an asset to have alternative financing that's off balance sheet, so to speak. So there are, again, but the understanding that you want listeners to have here is that, yes, you everything that you choose to do is going to be, interpreted and transparent to the market.
Got it. Now, just let's go back and then we'll go forward. SPACs as a way to go public. That was hotter than white for a little while there, maybe for a hot minute. I think that one's a little quieted out, but is a SPAC still an available method to go public? Sort of basically find a publicly available shell that has no operating entity and you plug into that and bam, you're public. Is that available?
So SPACs have a long history. They've been around for decades. And yes, they went, super white hot. Now they've cooled off. They are still available. There are still new SPACs being created on a regular basis. With that said, I'm not a fan of the route. I think it's good for the SPAC, promoters. It's good for the institutional money. It's a costly way of going public without a guarantee. So you can go and you can spend $1 million here and then get to the final vote where it's approved, and or the capital that's embedded in the SPAC doesn't stick. So then now you're in a position where you have to raise, additional parallel capital to get the deal done. And now you're, back now in the situation where many of the benefits of merging into a SPAC have gone, by the wayside. There are certain situations where you get a better valuation. You have certain benefits. Obviously, the ability to work with the promoter group on the SPAC and inside of an industry sector. So there are pros and cons. When the day is done, I've never been, a big fan of that, as it does represent an alternative method. There are also mergers that are being done with existing companies that are on NASDAQ or NYSE that went public, that didn't perform the way that they wanted, and are now, the ability to enter into a merger. That also, it takes almost the same amount of time, almost the same amount of money. And then you say, okay, well, what is the benefit? Well, there's, certain pros and cons to those as well. So there are alternatives in addition to direct listings. As a traditional IPO was on one side, direct listings have now come more on board with the advent of crowdfunding. And for certain companies that have strong following from consumers, subscribers, stakeholders, that's a very interesting route, which gives you much more control over the process. And so you have, from SPAC reverse merger, direct listing, in addition to the traditional IPO, as different methodologies of going public, resulting in a senior exchange, which is really the only place you want to be.
Right.
There is still an over-the-counter market,
Yeah.
and there are alternatives in other parts of the world. But from our perspective, if you're going to go through all this, the access to the institutional capital and the liquidity is no greater than anywhere aside from New York Stock Exchange or NASDAQ.
Got it. Awesome. So you have a book that you've published on this topic. Tell us a little, or about to publish. Tell us about your book.
It's published.
So where can we buy it?
It's available on Amazon.
Good.
And at Barnes and Noble, and it's called The Entrepreneur's IPO.
Okay.
And it's written as a practical guide, taking the experience not only of myself, but of many industry insiders. And I wrote the book over COVID.
Yeah, didn't we all?
Right. And on this one, I was actually able to, get it done and published and put out into the market. And it's really designed to meet this kind of knowledge gap that I found exists, to educate entrepreneurs of what's possible.
Right.
And if they choose to go down this path, that they have a resource to educate them about the different steps. There are 12 chapters in the book. Each one talks about a different step of the process, some of which we've touched on today.
Yep.
And the one thing that I'm both proud of and that's unique about the book is in each chapter, I took an industry professional. So in addition to my experience, I have this great community around me that has expertise inside of this area. And I asked different professionals to give their tips and techniques. So you have the inclusion of investment bankers, of auditors, of attorneys, even from exchanges. But we have participants from the London Stock Exchange and New York Stock Exchange and NASDAQ who have provided different insights and tips and techniques so that entrepreneurs have a picture of what it would take and what's possible, and then having some practical and knowledgeable advice should they want to go on and enter this roadmap of going public.
Got it. I appreciated the large font size personally. I barely needed my glasses. It was great. Well, Peter, this was awesome. I mean, a really interesting field, a little bit specialized. We only need this when we need it. But I think just your depth of knowledge and your insight were really deep, were appreciated. I think we probably educated people a little bit on this topic. If people wanted to get a little more time with you, what would be the best way to do that?
Yeah, I'm really happy to do that for your listeners. So I'm very active on LinkedIn. I put out a lot of information industry-wide, entrepreneur, leadership, and capital market related. Feel free to direct message me there. And, we can connect there, and I'm more than happy to get on a Zoom call and have an introductory call and see how I can add value. And the one thing we talked a little bit about, Jim, earlier that I want to underscore is that you don't need to be committed to doing an IPO now to start to go down this road. As many entrepreneurs have a dream of ringing the bell, which to me, I've had the humble benefit of doing many times. It never gets old for me.
Yeah.
I sat with a client yesterday who rang the bell recently, and we had the ability to enjoy discussion around that. And so what I want to be able to really give the message, which is the preparation and the systems and the processes of looking to go public provides tremendous value. And I'm committed to helping entrepreneurs, as they look through their own journey. And if I can add value, just connect with me on LinkedIn, DM me, and we'll jump on a call.
Nice. And I think that's a good final point. Like the methodology, the process you follow, thinking about going public, actually still help you even if you decide to do a private transaction. So there's no wasted calories here, particularly, which I think is a really important point.
Yeah, agreed.
Awesome. Well, Peter, thank you so much. It was great spending time with you. I wish you good luck going forward. And if people want to talk to him, find Peter on LinkedIn. Thanks, everybody, for joining us. We'll see you next time on the Lazy CEO Podcast. This podcast is brought to you by the CEO Project. At the CEO Project, we work with CEOs to help them grow their business. And our members represent billions of dollars of revenue and profit. And frankly, amongst all of us, we've probably made every mistake in the book, including some you haven't made yet. So if you want to learn from the experience of a bunch of really seasoned CEOs, we're a great place to hang out. In this podcast, what you're going to hear are some of those ideas, concepts, and things that are just going to help you on your journey. If you want to find out more, reach out to us at theceoproject.com, or you can contact me personally at jim@theceoproject.com. Happy listening.
Thanks for listening to the Lazy CEO podcast. We'll see you next time, and be sure to click subscribe to get future episodes, and check out our website, www.theceoproject.com.